Hi, everyone. Welcome to our quarterly Mortgage Trend Series webinar covering the latest news and trends impacting the mortgage industry. Before we dive into today's topic, I'm going to run you through some items to help you best leverage our webinar platform. Your webinar dashboard is interactive and customizable. You can personalize your view by moving, resizing, or hiding different elements on the screen. Simply use the corners of the icon to adjust the size or position of each box. You have many tools running across the top ribbon of your dashboard. If you can't find something, look there first. We encourage you to engage with us using the interactive tools. If you have any questions throughout, please submit them into the questions box on the lower left corner of your dashboard or press the Ask a Question button on your top ribbon. We will do our best to address your questions in real time. You will also notice a survey on your dashboard. Please fill this out anytime during the presentation. To let us know your thoughts throughout the presentation, use the emojis at the bottom of your screen. Your feedback is valuable to us and it is used to craft future webinars. Lastly, this session is being recorded. You will receive a link to the recording within a couple of days. If you want a copy of the slide deck, you can download it from the left side of your screen at any time. For those of you who aren't familiar with Richey May, we have served the mortgage industry for over 40 years. We have a full suite of services and products designed specifically for lenders. Our experts believe in the forward progress and success of the industry and dedicate much of their time to teaching. Today, our presenters include our mortgage banking expert, Seth Sprague, along with two special guests, Jeremy Shiers and Maria Fernandez. I'll turn it over to Seth to kick off introductions.
Thanks, Gabby, and good morning or good afternoon, depending on where you're at. It's just past noon here in lovely Denver, Colorado, where it's not 90 degrees today. It's only going to be 75. So if you're coming out for snow, you're in the wrong state. But we've got a great panel here. I'm going to allow them to introduce themselves. Obviously, I think most of you know me. I've been in the industry 30 years, Director of Mortgage Consulting here. But I'm going to let each one of my esteemed panelists introduce themselves. And full disclosure, I really never knew Maria Fernandez's title. I just always went and saw her in DC, but I actually never knew her title. I've probably been in her office a dozen times. So I'll start with Jeremy, and then Jeremy, why don't you give your quick intro, then turn it over to Maria, and then we'll get started.
Yeah, I'm Jeremy Shiers at Westgate Bank. I've been in the mortgage industry for most of my banking career, but in various capacities, between doing a few originations at a very small bank to starting servicing to running secondary, hedging, whatever. So varied experience across kind of all facets of banking and mortgage and regulatory. So we got a good lineup here, I think, and it's going to be a lot of fun, the discussion today. Maria?
All right. Well, Seth, Jeremy, so great to see you both. I am Maria Fernandez. I consider myself a housing geek. I have 25 years of experience in housing and mortgage finance. I just wrapped up my public sector career, and for the past 15 years, I led single-family policy at FHFA. And so my team was responsible for credit policy across the mortgage lifecycle, whether it was origination, collateral, servicing, asset disposition, mortgage data standards. At one point in my career, I dabbled in capital. I also dabbled in supervision. And I also was at PwC for a brief period of time where I was in a housing finance centric practice.
Great. And as you can tell, we've got very experienced panelists here. And in full disclosure, Jeremy and I have known each other for probably longer than either one of us were met. He's a client of mine that I help out from time to time. And I've been in Marina's office, former offices, the FHA, probably at least a dozen times, if not more, meeting with her and her team. Before we get started kind of with the trends, if you kind of missed our bingo card, this probably looks a lot like your NCAA brackets at this point. Actually, this probably looks better than your NCAA brackets because they're not a bunch of X's. But if you're interested in playing bingo with us this year, you could certainly download this card. Remember, this was done in January, and on our bingo card, we didn't have a war, and we didn't have gasoline going over $4 a gallon. We actually had it at $2.25. So maybe by the end of the year, some of these things will come true. But if you want to play bingo with us this year, remember, this was built in January, and again, a war was not on our bingo card. But for the topic today, we're going to talk, and look, there's so much going on in the DC world with policy and affordability and stuff being passed and stuff not being passed. We're going to try to walk you through several of the topics around affordability, and then talk a little bit about the Basel III capital rules that came out last week. And Jeremy is actually chair of the Mortgage Bankers Association capital markets group. So he's very familiar with that, and as am I. And Maria obviously has her strong background. And then we've got the grab bag, or the potluck, that we may or may not get to, which is a bunch of quick topics, which might end up being a lightning round. With that sort of as our backdrop, let's talk about affordability. And I'm going to start with saying something very positive. And for some of you on the call, that may shock you. But look, Washington, D.C. is actually talking about housing affordability for the first time, in the sense of they're not just trying to sort of juice demand for housing, which is actually counterintuitive when we're short the number of homes we need in the country. They're actually trying to figure out how to increase affordability. So we're going to walk through and talk a little bit about a couple of these executive orders that were signed on March 13th. And I'm going to probably start with Jeremy here. But as a generic background, these two executive orders were aimed at, sort of improving housing affordability, removing regulatory barriers, and promoting access. And the second one was promoting access to mortgage credit. And look, you'll get these slides, and this is directly from sort of the White House and their publications. But Jeremy, when we talk about regulatory burden, and you're welcome to talk as well about sort of access to credit, but executive orders, is that a really good way to try to change the industry and provide that really stable long-term viewpoint of what we're looking at? Kind of what are your thoughts about sort of these executive orders, and what do they mean, and what could they mean short-term, long-term, near-term, et cetera?
Yeah, I think there is somewhat of a misnomer in the news cycle that an executive order changes something immediately. For those that aren't policy geeks, if the administration tries to change something on a dime, a lot of times they get sued and they wind up losing in court because the change was considered what's called arbitrary and capricious. So it means that it happened too fast without contemplation. So the executive orders ultimately are ordering all the regulatory agencies to go study these issues and potentially change the rules. The rulemaking process is very protracted from the standpoint of they have to come back with a proposed rule, publish a proposed rule, go through a comment period, finalize the rule after the comment period, and then finally it goes into place. So, and I know we're going to talk about this later, but the timeline for these things, such as like this Basel rule that just got published as a proposed rule, that thing may not actually go final until closer to the end of this year, if not early in 27, just to get through all the notice and comment periods that are necessary. So while it's a step in the right direction to put the full force of the federal government towards trying to make things easier, it's still a protracted time frame to get there. Not as long as of a process as it is when you're trying to get something through the House and the Senate to be a law, because right now that is, I don't know, you could look at it as it's like watching paint dry, but I think that might be more entertaining. You can't get anything through Congress these days. And even then, once it's through Congress, you still have to go through the rule writing process, and it just takes a long time. So that is to say, none of this stuff's going to change overnight.
And that's a great point, Jeremy. And on our bingo card, we did have government shutdown. We didn't have multiple government shutdowns, but you can check that box for government shutdowns on your bingo card. I'm going to flip to Maria real quick. I find it a little ironic that on the page that we've got now, we've got these four magical letters that go together. I'm having a hard time reading them, but it certainly looks like CFPB. Now, I find it slightly ironic that there's an executive order ordering that agency, that CFPB, to do something. Is that organization still around?
They are still around. I have friends still at the Bureau. Now they are, kind of a fraction of what they used to be, of course. And, they were required to, kind of take a budget draw for the first quarter. And I imagine they're going to have to do the same, in the second quarter. The other thing that I think we need to remember is that, the CFPB was, it's built into statute. So I don't really think it's going to go away. I think they're just going to be, kind of a much smaller organization, at least for the next, 2.5 or so years.
And Maria, can you comment with your time at the FHFA about if you, I mean, not that you ever got executive orders, I don't know if you did or didn't, but like, what is the process of when that comes in? And can you give a little bit of just background as to, like, if you get ordered to do something, Jeremy sort of started the conversation, how long does that take? I mean, this isn't just, there's other day jobs that these organizations all have to do, right? And this gets piled onto that. Is that a correct way to think about that?
I mean, that's right. But, kind of, at the direction of, any administration, things need to be reprioritized in order to, accommodate, just shifting and changing priorities. It happens all the time. And Jeremy was right, oftentimes there is an advance notice of proposed rulemaking where you're getting, information from the industry and other constituencies to understand, the issues at play to inform your thinking. And then there's a notice of proposed rulemaking that, oftentimes has, 30, 60, 90 days of, a comment period. And then, the affected agency needs to, digest all of that, commentary period, get it through their governance process, legal at the various agencies, and so to get to final, usually, I'll tell you, just in my experience, it's 18 to 24 months. Things can certainly be expedited. But then, one thing you need to consider, it's, 18 to 24 months, but then there's an implementation period, right? And so, just because it lands as a final rule, you have to give, the various impacted stakeholders the opportunity to build in whatever you're asking them, to do. And so, that could take time, as well. So, it can be protracted, and that's not to say it can't be expedited as well. But in my experience, that 18 to 24 month window plus some sort of implementation timeline is what it takes.
And we all know that the mortgage industry is sort of always slow to sort of implement things because we have technologies, and then we have technologies that we don't make sure it's working. Jeremy, from your standpoint, gut reaction, these got released on a Friday afternoon, probably about 4:30 Eastern, 4:30 your time. You're in Nebraska. What was your kind of initial reaction to that on Friday afternoon? And then maybe what was your reaction sort of on Monday or Tuesday morning when you probably had some more phone calls about these executive orders?
Yeah, ultimately, there was a number of items in the executive orders that it was a potpourri of things that actually we get to talk about later with the Basel capital changes. And I felt like maybe the White House did an executive order on something that was already in the pipeline so that they could take a victory lap on it, just because why not? And then the other group of things are things that are harder to do, and you can't do these the way that we had changes happening in 2008 with interim final rules and different things like that coming out, because we're not in an emergency or crisis situation. So the contemplative process has to go into play, but everybody was kind of confused that I talked to from the standpoint of how, with what has happened over the last, year plus of Trump 4.0, because let's face it, this is not 2.0. There's several iterations deeper into how fast they're moving the government compared to the first administration, first term. So it's really not 2.0. It's further than that. So Trump kind of 4.0, the way that they've kind of shifted things with the Bureau and shifted things with other regulatory agencies in the last 12, 14 months, how are they going to have the resources to actually do these things? CFPB has been slimmed down to the point that the governance community that they've had may not have capacity to write the new rules, may not have the capacity to do things. So then in order to do something quickly, you may be asking industry groups like Mortgage Bankers Association or Home Builders of America or others to provide model text or model language for them to jumpstart their process, which can be very beneficial for the industry that is advocating. But on the other side, it shortcuts the contemplative process. So what are the second and third order impacts of the change, and have they been fully baked out? And I would say prior to 2008, a lot of the regulatory agencies would have told you that any rule changes took at least 5 years to get done because they were analyzed every which way from Sunday. So that way they knew exactly what all impacts were going to be across the board before they came out. And that contemplative rule process has gone out the window since 08. It was initially thrown out the window because you had to do it because of the response to the financial crisis. And then it's been expedient for administration since, whether it's the Obama administration, first Trump administration, the Biden administration, to shortcut these processes as much as possible because they're viewing the regulatory agencies as a political arm instead of the regulatory enforcement arm that they're designed to be.
That's a great summary. And Maria, I'm going to maybe put you on the spot here because it came in as a question. But obviously several years ago, Freddie Mac had started a home equity pilot. How long did that, if you can comment on it, and again, if you can't comment on it, say you can't comment on it, but how long had that pilot sort of been in the making? Because we got a question about, like, I think the timeline and the implementation around that Freddie Mac home equity pilot program. Like, I'm sure that there were numerous meetings around that. And that just wasn't one meeting. Can you comment a little bit or give the audience a little background on that one?
Yeah, so the new products rule has, very specific timelines for which, once you call something a new product, things need to occur within a certain cadence. I know I'm going to misspeak. So what I'd love to do is there is an FHFA fact sheet that outlines all of the timelines that you're required to meet. And if you don't meet them, you have to report it to Congress, right? So it's, when I was there, it was so imperative to meet those timetables, but I don't want to misspeak. So why don't I do this, Seth? I will find the fact sheet and I will send it to you so that, you and, your fabulous
we can
folks
get it out to folks. That would be great. I think a little bit of behind the scenes people are looking for. All right. Yep. So we've had the executive orders. Those got released on a Friday at 3:30 my time as I was trying to walk my dog. So that was fun, trying to explain to my dog why my phone was blowing up and making so much noise. Let's talk about Senate. On March 12th, the Senate passed the 21st Century Road to Housing Act. And I mean, the talking points here are very rarely are you going to see Elizabeth Warren and Tim Scott on the same side of an issue. But you had to hear, you got the vote of 89 to 10 to approve this. Subsequently, there's been a lot of chatter around this, and Maria, I'll probably start with you on this one, and Jeremy can jump in. But, look, I think everyone on the call, everyone in the industry is all for affordability and trying to create more affordability without creating undue risks or, kind of cratering the mortgage market, which we have done in the past. Obviously, this act isn't exactly what's done in the House, so we have to have this reconciliation between the Senate and the House. That's not kind of the question, but like when you saw this act pass from the Senate, kind of what were your reactions as to there's some good, there's some bad. I don't know where they came up with 350 homes. Makes a large institutional investor, but what were your thoughts around kind of the Senate side of this?
Well, I thought it was super just positive that we had bipartisan support for, greater affordability in home ownership. that in my mind was absolutely huge, and felt like, gosh, maybe we'll actually get some traction here. I agree with you. The issue around, kind of single family rental, it seems to, have put a wrench into, kind of the forward momentum that, I think we were all seeing. And we'll see if this moves forward or not. 350, I don't really know where that came from, because if you remember, FHFA, this was, oh my gosh, this could have been like 2017, 2018. Both Fannie and Freddie did some pilots in the SFR space, right? Yep. And we were defining at the time, kind of institutional investors to be 1,000 or more units. So, 350 was that, kind of middle market, not the mom and pop that kind of dabbles in, single family 1 to 4. But there's this, that was just institutional. So I don't know where the 350 came from, but it really does look like it's going to be, kind of a bit of a hurdle. I do think, the MH stuff was pretty positive, right? Kind of getting rid of the permanent chassis requirement. It makes, the difference between MH and modular kind of a bit more fungible, and, may enable broader acceptance when it comes to state and local zoning. So I thought that was really positive. There were also, there were some things about that overlapped, I think, with the executive orders around small balance loans and appraisals. But, I was also happy to see that the appraisal modernization piece of it, kind of reintroduced the reconsideration of value issue that was worked on back in 2024 between FHA and FHFA. Now, the GSEs went ahead and, implemented ROV into their selling guides. FHA kind of pulled back, but this looks like, ROV, that consistent ROV policy, could happen in the future. So all in all, I think it's, just positive to see, kind of that bipartisan work.
Jeremy, I'm come to you. I mean, obviously, I agree with you, Maria. Very positive on a lot of ways. And in a lot of ways, some of this was sort of just cleanup or proposed cleanup that the industry has talked around manufactured housing for a long time. But Jeremy, from your perspective, you're, a community bank, you're big into mortgage, you've got a correspondent channel, you have servicing. What was your sort of take on sort of the Senate's bill, which again will need to get reconciled in the House somehow?
Yeah, ultimately, the vast majority of what's in there is great. It's all trying to advance the ball the right way, moving things the right direction. There's some key differences between the House and Senate bill that they're going to have to work out. Some of the manufacturer provisions are great. The private investment pieces are nice. The institutional investor one is probably the one that's got me scratching my head the most. So this is where I have to throw the commercial in that the views expressed on this program are mine and not those of the host or the company and the radio station. But I get the idea of wanting not to have institutional investors because they're potentially soaking up housing supply. That's a two-sided coin, because if you remember back to the financial crisis in 2008, and I saw this firsthand, although from a short distance, Seth was in front row seats, where Denver and the eastern slope of the Rockies was substantially overbuilt, and they had entire subdivisions that had nobody living in a house. Institutional investors came in and bought those, stabilized the floor on the value of the market so that it didn't continue to collapse, put renters into those properties at an affordable rate, held them for a number of years for the property values to reappreciate, but also for the market to be able to absorb supply that would be for sale. And then almost all of them have divested. because it made sense from them from an economic perspective to do so. So, you know, at this point in time, people are negative on investors owning property because they see that as driving home values up. But you have to also remember the other side of the coin. They can keep home values from precipitously falling. I struggle intellectually and on this particular issue because I don't know if we're getting a larger good than we're getting a larger bad because there are two sides to the coin.
And Ivy Zelman was on a Walter Dunlop call yesterday talking about this, and others have talked about this. And there's been a couple actually builders that have subsequently, after this has passed, released earnings. And the builder's response is, well, we're going to build less homes. Like, so because of the point that Jeremy just talked about, right? Because there's a certain percentage of those homes, whether they're single family rentals or whatever, they do sort of soak up the market, sort of apply I don't want to say a guaranteed margin, because if you're looking at home builders margins, they're looking like the stock market straight down, but there is a floor there where they come in, and the removal of that floor, one of the publicly traded builders said, this will signal on every one of our models just to build less. And I mean, that's not what this bill is trying to do. It's actually trying to build more. But Jeremy, that concept that you just talked about is very valid and has been talked about now since the 2 weeks of this. And I think that's a huge sticking point. And then the second side of that is, okay, so if you are deemed a large institutional investor and you know you have this sunset or you're grandfathered in, but then you have to liquidate, whoever you liquidate to is now subject to a 7-year sunset, and that dramatically changes how they look at the cash flows of any investment. So this one piece could really actually have the opposite impact that it's looking for. And I mean, I'll say it because it's easier for me to say it. I am sure the polling numbers, when they call you at 1-800-POLL at night at 6:30, go, hey, what do you think about institutional investors owning single family homes? I'm against it. I'm sure it scores very well when you present it as that question, and therefore you get it in legislation like this, but it could actually have the opposite effect.
That's where,
okay. Go ahead.
That's where I struggle on the process from the standpoint of there is a reason we are set up as a representative republic, because a direct democracy, the mob, as it were, if you go back to the way that the Romans referred to it, is a bad way to run a government, because the mob moves in different ways and is not always contemplative with what is the best thing for the country, rather than, you know, just what's the best thing for me today. So there's a reason we have the system of government we have, and that's to stop bad ideas from actually making it into law. Unfortunately, in today's hyper politicized environment, bad ideas can get legs very quickly, and then you can't get out ahead of them and stop it.
Yeah. And we took many of those bad ideas out of this presentation because Jeremy and I didn't want to further the conversation around certain bad ideas that have come out. More recently, March 18th, Fannie and Freddie came out with a change to homeowners insurance. And this gets into kind of a technical conversation. And Jeremy, I'm going to point to you first and then go with Maria second. But, you know, this is coming from, you know, FHFA talking about how this is a big win for condo owners and buyers. And the issue, to boil it down, is, you know, condo buyers that they can now use the actual cash value on RUs versus the RCV, which is the replacement value. And as you might imagine, on a 10-year-old building or a 15-year-old building, that actual cash value will be significantly lower than the true replacement cost. Therefore, it's cheaper insurance. Therefore, we've solved affordability, a portion of affordability, because now those borrowers will pay less insurance. Jeremy, does this sound like a great idea or not?
This is where I would say there is no such thing as a free lunch. If you are not paying for replacement cost value insurance, you need to be taking the delta and putting it into some kind of a sinking fund in order to actually replace your roof. Because we all know At some point in time, whether it's just due to age and obsolescence, you need to replace the roof, in which your insurance is never going to help you with, or you're going to have an event, an peril event, high wind, hail, something that's going to create the necessity that the roof be replaced early, in which replacement cost value would have paid for it 100%, whereas actual cash value is going to pay a depreciated amount. And if you don't have the cash laid aside to cover the delta, then now where's the money coming from? And the insurance industry was previously getting that money because of charging the higher premiums. If you're taking advantage of a lower premium and you're not saving the money, where's it coming from? Condo associations are going to wind up stacking more and more assessments against properties to replace those roofs at that time, if they go with ACV coverage, which most of them will. And homeowners on the 1 to 4 side are going to hopefully have equity in the properties to be able to do home equity loans in order to pay for the roofs, because that's just the cycle that it's going through. And I was recently told that one of the large insurers in the state of Nebraska, and I know it's different in every state, that in 5 years, they don't anticipate anybody's going to be able to get replacement cost coverage on a roof unless it's a grandfathered policy.
Yep.
So this is an issue that we have to deal with on an ongoing basis, where the insurance industry, trying to control their risks, or lowering the amount of benefit they're putting into the coverage. It's good that FHFA and Fannie and Freddie have now gotten on the same page from the insurance perspective, that this is no longer feasible to require actual replacement cost coverage versus actual cash value. But from a homeowner family that's in that property good, we now have to come up with a way to help them create the sinking fund that they're going to need. Because what happens if we have another 08, 09 situation and housing values drop 20, 30, 40%, and then you have a hailstorm and you need a new roof and you're underwater on your mortgage loan, but you can make your payments, who's going to loan you the money to replace the roof on your house?
Yeah, it's a tricky wicket. Maria, I'm going to loop you in here, obviously, and you feel free to comment as much or as little on this. Yeah. Obviously, you have some probably insight or had some insight. This is obviously being worked on while you were there. But again, I like Jeremy's comment, right? There's no free lunch here. Can you kind of expand a little bit on your thoughts?
I mean, I agree with Jeremy 100%, right? You know, an actual cash value policy, you know, effectively, you know, a roof typically has, you know, anywhere from a life of 15 to 20 years, right? And so that policy depreciates, you know, the value of that roof kind of depreciates. And so that borrower, that 1 to 4 borrower, right, you know, when there's a disaster or just, you know, kind of the life of that roof, you know, has come to its natural end and they need to replace it, they're not going to be able, many aren't going to be able to do it. I would say most aren't going to be able to do it. I took a look at what, you know, kind of what it costs in Washington, D.C. to replace a roof. Now it all depends on the size and how sophisticated the roof is. And, you know, but, you know, my friend, you know, Mr. Google gave me, you know, a range of anywhere between, you know, kind of $9,000 and, you know, $20,000. That's a lot of money for, you know, a homeowner to come up with. And if they can't, what happens? Do they go, is it loss mitigation? Is it a repayment plan? Is it, because I speculate that there are many borrowers out there, Jeremy, that aren't gonna, you know, be able to save for a rainy day. And I'm not quite sure kind of what you know, what the answer is. And from a disaster perspective, I really think we need to start talking about, you know, kind of resiliency, right? And, you know, I don't know if anybody has seen kind of like the fortified roof. I'm a big fortified roof fan. I just gave them a free shout out, but, you know, I think that's, you know, impressive. And, you know, building codes in certain areas have changed. And I think, you know, kind of those sorts of resiliency efforts need to be reflected in insurance rates and premiums. And so, I also, I do, feel like the insurance folks don't know a whole lot about mortgage, and the mortgage folks don't know a lot about insurance. And so I feel like sometimes the conversations just kind of, go past one another. I think there's a lot of education that needs to happen amongst, all of the parties in the ecosystem, but, specific to this issue between, kind of just, mortgage players and the PNC insurance industry.
I think this thematically comes back to a lot of things we're talking about. There's a headline here, right? All of a sudden, you'll get a lower insurance premium on that condo, but you're gonna have higher HOA fees, and they're gonna have a higher reserve there. Or will the borrowers actually understand, to Jeremy's point, that they're actually sort of self-insuring at this point? I mean, if you want to have your property values decline, have a bunch of blue tarps on roofs for a period of time. That doesn't do much to home values when the appraiser drives through and sees a bunch of blue tarps on the roofs. So again, Jeremy, you're a servicer. It sounds like this is an issue that's going to be really important for servicers and potentially a difference between banks and non-banks at that point, correct?
Absolutely, because you wind up with the loans that you're servicing if the roof is destroyed and there's a gap. As a servicer, you're going to have to do some kind of protective advance in order to complete the repairs, because you need to preserve the property. All the GSEs, all the guarantors will require you to do property preservation and advance the money. As a bank, I have access to deposits, so it's not as big of a liquidity concern for us. For the large IMBs, or really any IMB, I start to worry about what does that start to look like when we get 2, 3, 5 years down the line, and you start seeing swaths of properties that have damage and require protective advances. And are the IMBs going to be able to fund those corporate advances? And then even if they can, what do they do with the borrowers after that? Do they offer them some type of equity loan or junior lien program in order to try to create a loan that they can sell? Or do they go through the foreclosure process because the homeowner, it would be considered in default of the collateral documents for the preservation of the property? What's the ultimate solution there? And Fannie and Freddie don't really have guidance out yet on that. What are the GSEs going to do? Are they going to put together some type of partial claim program or deferred balance program where the GSEs are going to, and the guarantors on the government space, should they do this, are they going to be able to, fund the servicers on the front end, so that way those repair dollars sit out there till the end of the loan? There's a lot of questions on this, and the impact on servicing is going to be very interesting to see as this maturates.
We're going to flip to the next topic, but you could see a scenario where natural disaster comes through, rips off the roofs of the condos, they need to be repaired. Those borrowers are actually put into forbearance, because that's our new top of the waterfall, typically loss mitigation strategy. And now, so they're going to have that silent forbearance loan, and then they're actually going to have sort of maybe another, like you said, captive restrictive escrow that they're going to have to pay back on the lien on the roof. So it's an interesting topic. It's getting a lot of high fives out there, but now you're starting to see people go, wait a minute, this may not be exactly what is the answer to affordability. We're going to do a little bit of a hard pivot here and talk about potential capital relief. And this came out on March 19th. So, I mean, it's almost as if Gabby knew exactly when all these rulings were going to come out, so we can have this webinar like a week after all of them so that we could talk through them. But Basel III Endgame, or Basel III Final Rules, or Basel III whatever movie that they're going to reference at the end of this has come out. And the comments are due back by June 18th of this year. And I mean, one document's 454 pages of fun. Another one's over 1,000. I got to page 14 on the first one. Let's talk about one of the things that I know the industry has asked for. The Mortgage Banker Association has sort of asked for, among other things, two things. One, relief on the warehouse line from 100% risk weighting to 50%. I didn't necessarily see that in the document. Jeremy, you can correct me there. And the second one, which I think is a really interesting one to talk about, because it depends on your definition of banks, but there's a proposal, obviously, to remove the 25% Tier 1 common equity cap from a set of banks so that they can hold more MSRs to Tier 1 common equity and not have to deduct it from equity. That's great. But what they didn't change was the risk weighting. It's still 250%. So, Jeremy, you're a under $10 billion community bank that's big into mortgage. So can you talk a little bit about kind of maybe your perspective on this rule for where you sit now, and then maybe a little bit larger perspective on what it may mean for some of our larger banks?
Yeah, as a bank subject to what's called the Community Bank Leverage Ratio, CBLR, we view this as highly positive because CBLR banks don't have risk weighting. It's just a pure capital ratio, which is substantially higher than the minimum capital ratio required by Basel banks. So we do carry a lot more capital than a Basel equivalent bank would. So the elimination of risk weightings makes sense in that regard. But this is going to allow us to continue to expand into mortgage servicing at a faster pace than we have been in the past because it's a much more friendly capital regime. The interesting part about it is the examination community, the regulatory community, has the authority to force any smaller institution into the Basel regime if they deem necessary. So we have to stay on top of what the Basel requirements and rules are. So I always keep on top of what's going on there. And ultimately, the 250% risk weight is, I'm not going to say it's the primary governor on why the regional and super regional and national banks haven't jumped back into mortgage or have exited mortgage for a lot of them, but it is one of the major drivers. Mortgage servicing requires scale to be good at it and to be profitable at it. And then to get that kind of scale, that's a large investment. Most of those organizations wouldn't have got to a 25% cap. But when you look at the punitive capital treatment of the 250% risk weight, the rate of return on the mortgage servicing asset as a whole doesn't meet their capital rate of return thresholds. So removing the cap is great because it gives lots of headroom, and we are a beneficiary of that because we've been bumping the 25% for a while. But for the large banks to get back into mortgage servicing in a material way, this 250% risk weight really needs to be lowered. Otherwise, this is going to be a headline, and it's going to be form over substance because it's just not going to move the needle.
Yeah, I called it the biggest nothing burger for banks that aren't under an alternative CBLR under 10 billion total assets. Maria, at your time at the FHFA, obviously you saw a dramatic shift of who was servicing maybe when you first got there to when you exited, obviously the banks exiting and the non-depositories coming in. Again, from your kind of seat now that you're outside of public service, do you see this as the reason why banks will now come back in because that 25% cap that they weren't even close to was lifted? Or is this just, what's your thoughts?
So absolutely. I saw the shift from when, mortgage was all in the hands of banks, and the shift. I mean, it just did a flip flop, like, kind of 80, 20, 20, 80. It was fascinating to watch. I agree that, more friendly capital rules, could entice, kind of banks back into mortgage. However, there are other reasons why, kind of banks have sat on the sidelines, whether it was, kind of False Claims Act concerns or compliance risk enforcement type of issues. So I don't think it's all about capital. And interestingly enough, if you walk through the EO on access to credit, you will see that there's a section that discusses, enforcement, and it's asking the federal regulators to consider promulgating policy against enforcement action for violations of consumer financial laws. I thought that was really interesting. So clearly that, kind of compliance risk is still on the mind of, kind of mortgage players because it found its way into the EO.
Yep. Yep. You're exactly on. And we got a couple of questions on this. Because this is like favorable treatment or moving the needle in a positive direction, can something like this pass faster? And I think the answer is no. It's still got to go through the comment period, right? Then they got to assess the comments. Then they may actually re-propose at that point based on those comments, or they could go to a final rulemaking, right? So June 18th is an implementation date. And I mean, Jeremy, you kind of said maybe by the end of the year. That may be aggressive considering the number of comment letters they're likely to get on this. This could very well trickle into next year before they even get through the comment letters. It would be my sort of take on this one.
Yeah, I don't disagree. The comment and the analysis of the comment and the rule drafting requirements that they're going to have to address the different areas of commentary through the final rule or the finalization of the rule. That's going to take time. That's not an easy, you're not going to wave a magic wand to get that done. So, we're bullish on this kind of getting through as far as at least the 25% cap going away. We think that's beneficial. The 250% risk weight is the hindrance. And really part of what has to go into some comment letters has to go into the side of de-risking the economy. Because yes, the economy suffered under what was predominantly a mortgage-related genesis of the 2008 financial crisis. I'm not going to say that mortgage was responsible for it. Mortgage was maybe the catalyst for the implosion to occur. Because of that, the regulatory agencies, the FDIC, and actually the Basel Committee, driven by the French, decided that mortgage servicing was too risky to have in the banking world. So this is where those rules came from. We've now driven mortgage servicing out to non-banks. And while we have done a fabulous job de-risking banking, have we actually de-risked the economy? Because who is going to step in and resolve a large independent bank or large independent servicer if they fail for whatever reason, and maybe of no fault of their own? We could have another liquidity freeze up that would create a problem for a number of institutions, and they may need help. If the capital rules are so onerous that none of the large banks are willing to step in and take on that servicing book, who's going to do it? And it's going to create a massive issue with who's going to own that servicing, who's going to deal with it. Is it going to be Fannie? Is it going to be Freddie? Or is Ginnie or the underlying guarantors going to have to find their own path? Or do you adjust the capital rules so that from a economic perspective for the overall economy, you can actually have a merger of one of these large IMBs with one of the large banks in the country and not have major disruption to the underlying families that are paying their mortgage loans to these companies?
Banks currently restricted. If you're a GSEB, it's 10%. If you're not a GSEB, it's 25% of Tier 1 common equity. Many IMBs are well above 100% MSRs to equity. So banks are here, IMBs are here. I think the second piece of this one that's of interest, and again, just to sort of level set, banks are really effective at hedging their MSR asset. They have very sophisticated programs. They have a lot of skilled people working on MSR hedging. It's come a long way since 08. And hedging wasn't a problem in 08 either, but it's even gotten more sophisticated since then. Ginnie Mae, with their risk-based capital rules, actually gives credit for their risk-based capital calculation to reduce the MSR in that formula for effective hedging done by IMBs using financial instruments. Well, banks certainly use financial instruments. And if you look at banks' effectiveness on MSR hedging, I mean, they are very good at it. And so maybe some layering in of if you effectively hedge your MSRs, then you could get some more capital relief. If you don't, that's fine. But there's a long way to go on trying to get the risk weighting down so that we could get, if we really want the banks back in, we probably need to change the risk weighting. Okay, we're going to go to a rapid fire round. So we've got a grab bag or the potpourri or the crock pot. Each one of these topics we're going to probably spend about a minute on. I'm going to handle the first one because it's the snarkiest one of them all. And so I'm going to handle this one. But this is the 10 basis points of G fee that's still hidden there. So in 2021, for those that don't remember, we implemented as an industry a 10 basis point G fee increase to pay for a temporary tax contribution cut act of 2021 that subsequently announced some infrastructure bill from 2015 or 2016. The math back then was for a $200,000 mortgage, the 10 basis points represent about $15 a month. And if you over a life of a loan, $5,400. Well, I did the bad math this morning. At a 6.5% mortgage rate versus a 6.40 mortgage rate, the average savings is $26.25 a month, or $315 a year. And if that loan lasts for 30 years, which we know it won't, that's $9,450. So I say this again from a consulting view, but if Washington, D.C. actually wanted to actually move the needle a little bit and do something that was like taking away one of the hidden taxes, maybe they should take out the 10 basis points of G fee that was long since put in now almost 14 years ago. This is a hidden tax that everyone that has a mortgage is paying. And this one, unlike some of the proposals, Jeremy, probably wouldn't cause a refinance wave. Thoughts?
You're not going to see a major shift in people's prepay speeds because there's a 10 basis point reduction in loan rates because of the G fee. This actually would be more effective than the GSEs buying $200 billion worth of MBS securities because, well, that did tighten mortgage spreads more than 10 basis points initially. That's all gone now because they've all widened back out. And this is a guaranteed 10 basis point narrowing, not a, well, the market feels like it needs to change because we have another buyer. This would be meaningful change immediately.
Maria, again, sort of put you on the spot here because this has FHA. Congress directed FHA to do this. It wasn't FHA's decision. FHA, but again, thoughts on has this even come up in, as something they should do
during my tenure?
Yeah.
No, I don't recall having these conversations during my tenure. Mm-mm.
Yeah. So it's just, I say it's just don't always believe the headline is to somebody who's telling you that they're doing something. I know one of the areas that's a hot topic right now is recapture income. Maria, you probably had a bunch of folks that came in and talked to you about how they were hedging their MSRs using recapture and all this stuff and how great it is. Well, the EITF has actually green-lighted recapture as part of servicing value. Now it's up to the FASB to deliberate, to potentially say this is actually going in and what that might look like. This EITF does not constitute changing GAAP at this point, but this probably puts it on a path to potentially put recapture in. Again, you look at counterparty risk, you look at business models. I have my own strong opinions of recapture. I know Jeremy has his strong opinions of recapture, but what are your thoughts around how servicing is already a tangible asset? Now I'm going to put more stuff in it. It looks like originations. How does that feel?
You're putting me on the spot here, Seth. And I think that says it all. I'm not sure.
Jeremy, from your perspective, what do you kind of think about recapture as part of a servicing cash flow?
Ultimately, this is just putting a financial value on borrower behavior. And so I start going down the line of, where do you stop on this slippery slope? Because I'm a bank, I've got, 30,000 checking accounts. I know that we're going to be able to get X percentage of mortgage loans from my 30,000 checking accounts. Does that mean I get a book of financial asset based on the value of the checking account relationships? It's so similar that I could make the argument. So it's very difficult. banks haven't been able to count recapture as part of their mortgage servicing since the OCC issued a letter on it, I believe in 1989.
And then it was refreshed in 2002 and 3.
Yeah, I mean, so it's been a very long time that in the banking space, this has been settled issue from a regulatory and regulatory accounting practices, that you can't count it. So this is really a rehashing of an issue that has been decided for 30 plus years in the banking space, in the independent space. And in my view, if FASB does change GAAP, then the regulatory agencies are going to have to go through the deliberative process to say whether or not they're going to change RAP so banks can count it. Otherwise, You're picking winners and losers, because the IMBs can count 15, 20, 30 basis points in value on recapture that the banks can't. That's just not going to work from an economic perspective in the market.
And the EITF does say apply to all entities, but that's up to FASB to figure that out. We already covered kind of MBS purchases, so we'll skip this one. Maria, coming back to you. Fannie and Freddie IPO, which I will tell you was a really hot topic a while ago. And boy, that seems to have really simmered down.
Yeah.
Kind of what are your thoughts here?
You know, my crystal ball is really murky, but you know, I feel like when these conversations were happening, you know, just a very different point in time. I think, you know, there are, you know, priorities that, you know, I think are taking the administration's focus, you know, kind of elsewhere right now. Your guess really is as good as mine. You know, although I will say, you know, I do think policymakers like the ability of, you know, influencing mortgage policy through the GSEs and through the conservatorships. I think they like the 10 basis points. And so I wonder, you know, whether or not, you know, kind of there's really, you know, any will to make a change given those two things and other things happening kind of geopolitically to focus on this right now. I don't know.
Yeah, I agree. I think it's very difficult to tweet them out of conservatorship, and therefore, I would agree that murky is probably a good way to put it. I'm going to cover the last two slides really in lightning round, and we'll get everyone out of here. But if you're not aware, obviously FHFA has changed its loss mitigation strategy. You see a lot of headlines about rising delinquencies in the FHA space. A lot of this does have to do with this change of policy. We'll see how this plays out. This is to protect the insurance fund, but we'll see how this actually plays out longer term. And then finally, if you're not aware, there's a lot of M&A going on in the mortgage space, and there continues to be a lot of M&A going on. And some of these deals may close, some of these may not close. But at the end of the day, you are seeing sort of a roll up in some ways around the origination and servicing, which is also causing many IMBs, in my opinion, now question who they're selling loans to, and maybe they should start retaining servicing, because all of a sudden they value that customer. And of course, if they could put recapture income, then it may make more economic sense. I'm just going to wrap up with our final thoughts here. Look, policies could change quickly. They may have changed while we were on this call. The key takeaway is read beyond the headline. Like, the headline's one thing, but understanding its real implications, like we talked about, is very important. Understanding all this potential regulatory changes is very important, and stay engaged. Whether it's at your state and local MBA, or if you're going to advocacy with the MBA next month, stay engaged, because your voice needs to be heard in the industry. With that, I'd love to thank our panelists, Maria and Jeremy. Thank you very much for allowing me to twist your arm and to come on this panel with me and talk about these policy changes. We really appreciate your time and effort. The slide deck will be available. And just again, thank you very much. Please fill out the survey, and we'll be back next quarter with a different trend series. Hopefully this is a good walkthrough and you got some good takeaways. We'll follow up with all the questions that we didn't ask, that didn't get answered to separately in the email. But again, thanks everybody for your time, and have a good rest of your week.